Great, Heavenly Delights. Now we're starting to get a little bit closer to what you can expect as a question in the exam paper. It's not straightforward. You'll see in this whole question, if you run through the question, you see there's very little tables. It's only one small little table, so it's not your traditional income statement, statement of financial position, etc., etc. So this question in its whole entirety is very important because it really tests whether you can read and do and understand. Heavenly Delights is a small but popular shop in Cape Town, South Africa, which supplies quality baking supplies. Heavenly's accountant, Mr. Moores, had to go unexpected sick leave and consequently could not finish the company's set of financial statements for the year ended 30 September 2016. Heavenly's managing director, Mr. Bakerman, is a good friend of your parents, and since he knows that you are a keen accounting student, we ask you to assist in the finalizing of the statement of cash flow for the 2016 financial year. Mrs. Moores is a well-qualified and experienced accountant, thus you can rely on all the information prepared by her so far. While going through the files on your desk, you came across the following information. And you can see there's a lot of information required. Prepare the statement of cash flow of Heavenly for the year ended 30 December 2016 by using the direct method. No notes. Reconciliation of cash generated from operations, all comparative figures are required. There's only one note, and that is the reconciliation note, but that is not required. Direct method means we're going to start with cash received from customers. Now let's quickly go through these additional points that they actually raised here and see what it's all about. Number one is all about tax. Number two is profit before tax. Guys, you can read here. Profit before tax amounts to 336,968 and profit after tax amounts to 308,700. So therefore, just by reading it, what is our taxation expense for the year, or my tax charge for the year? It's the difference between those two, the 336,968 and the 308,700. So that gives us a tax expense for the year of 28,268. Then they give us total sales, and they tell us it's all on credit. That amounts to that amount. Included in the amount for trade receivables is an amount written off as irrecoverable during the year of 8,200 Rand. And then number 5 is all about shares. Number 6 is property, plant and equipment. Number 7 is also about property, plant and equipment. It's going to say production machine. And then they have a delivery van. So slowly but surely, we are doing a little bit more integration in your questions, and that is for sure something that you can expect. Then we have a loan. Then we have interest income received during the year. Then we have dividends. I declared the following dividends: an interim dividend and a final dividend. All shareholders are South African residents. You obtained the following closing balances as at 30 September 2015. That's last year. The audited financial statements, trading stock, trade receivables, trade payables, tax and bank. You noted the following while comparing the 2015 balances with those of the 2016 trial balance. You don't have to work out the movements, they give you the movement. The trading stock closing balance is 12,000 Rand less than this year because Mr. Bakerman decided to order new stock after year end. The trade receivables balance of last year is 4533 less as per the current year because the debtors seem to pay slightly slower as a result of the current economic environment. The trade payables balance increased with 33,200 Rand due to a late payment to a creditor. Okay, so we are going to start with cash received from customers. And our first point is, how much was our sales for the year? And if you can remember correctly, they gave us that amount somewhere. total sales, all uncredited, amounts to 2986667. Now, you can do this in two ways. I would propose that you do the debtors account in T format. So therefore, you're going to start with an opening balance of trade receivables. And there's my opening balance, 89,700. Closing balance, the trade receivable balance of last year is 45333, less than the as in the current year. So therefore I have to add the 45333 to the 89,700 to derive at my closing balance. So there my closing balance, 135,033, and that equals, I'm going to add it in here. That is those two together. So that is just that you know in future how it has been determined. 89,700 plus 45,333. Good. Now, going back to the question. So we've done and dealt with that one. Somewhere along the line there was also something about trade receivables. Included in the amount for trade receivables is an amount written off as irrecoverable during the year of 8,200, so credit loss is 8,200, and then total sales, all on credit, 2986667 on the debit side of that account. 2986667 sales and credit losses, 8,200. And now we have enough information to determine our bank figure, and that is our total cash received from customers. Or alternatively, you could have used your sales account and then you could have adjusted it with the increase in debtors which took place in the current financial year. So they tell you here the trade receivables is 45333 less than this year. So therefore this year's balance must be the higher one of the two. Increase of 45,333, but remember now our credit losses there of 8,200, so that movement would have been even more if it wasn't for credit losses. So therefore I'm going to add the credit losses of 8,200, 135,033 plus 8,200 less 89,700 gives you your movement for the year of 53,333. Total cash received, 2933134, and I park it on my statement of cash flow. The second thing that we want to do is the cash paid to suppliers and employees. Now, let's see how far we're going to get with that one. Where do we start? We start with our profit before tax. Now, our profit before tax, they gave us that figure right here at the beginning. The profit before tax amounts to 336,968. So that is the figure that we're going to start off with. And then we're going to adjust it, number one, for our revenue figure, which is 2986667. So there it is. We take out the revenue, 2986667. Good. Then credit losses written off 8,200, non-cash flow item. So therefore we're going to adjust for non-cash flow items. Credit losses written off 8,200 rand. Good. Now we're going to have a look at the depreciation calculation or the PPE calculations as a matter of fact. On 30 April 2016, what is our year end, guys? Our year end is September 2016. So at 30 April 2016, Heavenly bought a new machine used for the production of icing sugar at a purchase price of 483,500 with some of the cash raised from the share issue. The machine was installed on the same day. Mr. Bakerman estimates that the machine has a residual value of 30,000 rand. The company which sold the machine to Heavenly is of the opinion that the machine can produce 180,000 kgs of icing sugar. This is our rest value. So we can work out an amount which is going to be equal to what is our depreciation charge per kg, which will be 483,500 less 30,000 divided by 180,000. By year end, the machine already produced 36,000 kg. Then we're going to multiply that by 36,000, and we're going to get the depreciation on the new machine. So let's have a look at the depreciation. New machine, 483 less 30,000 is the depreciable value of 453,500 divided by the capacity of 180,000 multiplied by 36,000 gives us then a depreciation of 90,700 on the new machine. The old sugar production machine was sold on the same date, so on the 30 April, as the new one was purchased. The old machine was bought initially for 320,000 on 1 January 2014 and had the residual value of 20,000 Rand. Right. The machine was expected to produce 60,000 kgs of icing sugar. So once more we can work out what is our depreciation charge per kg. 320,000 less 20,000 gives us 300,000 divided by 60,000 gives us 5 Rand per kilo. 39667 of these kilos were produced by 30 September 2015. So that would be our opening accumulated depreciation, 5 times 39667 and 5 times 11,333 would have been our depreciation for the current year. And then they tell us that a profit of 18,500 Rand was made on the sale of the asset. So let's go back. The machine which was sold, depreciable value 300,000 divided by 60,000 multiplied by 39,667 gives us accumulated depreciation at the beginning of the year of 198,336. For the current year, it's 5 Rand multiplied by the kgs of this year, 11,333, gives us depreciation for the current year of 56,665. So the carrying value at the date of sale is the cost price of 320,000 less the 198,335 less the 56,665, which gives us 65,000 Rand. We made a profit of 18,500. So therefore the proceeds on the sale of this old machine, 83,500. So let's dump it in our cash flow statement under investing activities. New machine purchase replacement, 483,500. That was the new one that we bought, and the proceeds on the machine disposed of, that's the one that we've just calculated, 83,500. So the new machine, 483,500, the old machine, 83,500. Great. Now the delivery van, which is the next step here. Heavenly owes, well, before we walk away of that one, remember that the profit on the sale of 18,500 is also a non-cash flow item. We're still in the process of calculating depreciation, but we can definitely park that profit in the meantime. Profit on the sale of the machine, 18,500. And if I've used this one, profit actually increased profit before tax. Therefore, I'm going to subtract that when we're going to take it out of our profit before tax figure. The delivery van was purchased on 1 July 2014 for 120,000 Rand. This delivery van has depreciated on the straight line basis over 5 years and have a residual value of 10,000 Rand. So the depreciable value, 110,000 divided by 5, and that's going to give us the depreciation on the van, which gives us 22,000 Rand. So total depreciation for the year then is going to be our 90,700 on the new machine, 56,665 on the machine which was sold, and then on the delivery van, it is another 22,000. So our total depreciation charge for the year, 169,365, and we're going to dump it here where it should be as a non-cash flow item. We're going to add it back to our profit before tax, 169,365. A loan due to Netfin Bank with an opening balance of 300,000 was repaid halfway during the year. let's do that. The loan was repaid. So financing activities, loan repayment, 300,000 rand. The loan carried interest at 10% per annum, so that gives us 30,000 rand per annum interest. The interest was 6 months up to the repayment was paid together with the loan balance. So for 6 months, 30,000 divided by 2 equals here interest of 15,000 rand. Separately disclosable item. Let's go and do that. Separately disclosable item. Interest paid, finance charges, 15,000 rand. We're going to add it back because it reduced our profit before tax, 15,000 rand. Interest income for the year totaled 24,400. Separately disclosable item, interest income, 24,400. We're going to subtract it from our profit because it increased our profit. There it is, separately disclosable item, interest received, 24,400. Guys, in interest paid and interest received, there's nothing more on those items. So interest received here as a separately disclosable item, 24,400 in our cash flow from operating activities, and our interest paid was the 15,000, which we have just worked out. So we can dump those figures as well. Dividends. Now for the dividends, we have to read number 5. Heavenly increased its shares with 50% by issuing 10,000 ordinary shares at a share price of 47.50 Rand per share at 1 April 2016. So that means that we've issued 10,000 shares at 47.50 Rand, and that gives us 475,000 Rand. Proceeds on the issue of shares, 475,000 under financing activities, 475,000 income. Now, if we increased our shares by 50,000 and that was 10,000 shares, how many shares did we have before 1 April 2016? We had then 20,000 shares before then. 50% of that equals 10,000. So we used to have 20,000 shares up to 1 April 2016. And then on 1 April 2016, we increased our shares with 10,000. So from that date onward, how many shares did we have in issue then? 30,000 shares. So if they give me the dividend, 1 Rand per share on 29 December 2015, was that before or after the new share issue? It was before. So how many shares were in issue then? 20,000 shares. So therefore here, if I work out my dividend, it's going to be 20,000 multiplied by 1 Rand equals 20,000 Rand. And then for the final dividend of 1 Rand 67 per share, there I have, or now I have, 30,000 shares issued multiplied by 1 Rand 67, and that gives us then a total dividend of 50,100. Right. Now, they tell us they declared and paid the following dividends. So therefore I can add those two together, and dividends paid under my operating activities, I can go insert that figure. Dividends paid, 70,100 Rand. So guys, can you see, as you do your cash flow statement, please go, as you go along, please complete what you can complete in your template. Great. Now let's see, take stock. Where are we with cash paid to employees and customers? We had our profit before tax, we had our revenue, we had our profit on the sale of the machine, we had our interest received, we have our depreciation. Credit losses written off we have, and we have interest paid. So total expenses, 2,500, 034. 2,500, 034. Just that one, which is this one. So we have the expenses in the income statement. All we have to do now is to adjust that for the accrual principle. Now, in our question, they tell us here that the trading stock balance is 12,000 Rand less this year. So there's a decrease in stock, and a decrease in stock equals an increase of cash. So that equals 12,000 Rand. They further tells me that the trade payables balance increased with 33,200 Rand, so an increase, and that is also a cash inflow. Increase in payables, 33,200. So total cash paid to suppliers is now that sum total, 2,454,834, and that we're going to park there, 2,454,834. The difference between those two equals my cash generated from operations, 478,300. We've already completed interest received, we've completed interest paid, we have completed dividends paid, tax paid. Well, taxation payable in the beginning of the year was 22,787. Plus our tax charge for the year, that we have established quite early, was 28,268. And now all we have to see is whether they tell us how much tax is still outstanding at the end of the year. The very first bullet point says there is no tax liability at year end, but the trial balance shows that the tax refund is due from SARS as of 3145. So at year end we have a debit balance on our SARS account of 3145. You see taxation. Opening balance to 22,787. Our tax expense for the year was the difference between profit before tax and profit after tax of 28,268. And then our closing balance is a debit balance of 3145. Therefore, we've paid the receiver of revenue 54,200 for the year. In brackets, outflow of cash. So net cash from operating activities 363,200. Inflow, our cash flow from investing activities, we have the new machine, we have the proceeds on the old machine. So the total net cash flow from investing activities, an outflow of 400,000. Loan repayment we have the proceeds on the issue of shares, so we have the total net cash from financing activities. Now our cash and cash equivalents. We only have our opening balance, 48,680. So we can park that, 48,680. But guys, now we can actually calculate what should our net or increase or decrease in cash have been for the year. How? We're going to take that 363,400. We are going to minus 400,000, which is our investing activities. We are going to add 175,000. And that will give us this figure of 138,400. If we have the 138,400 and we have the opening balance, then we can actually calculate what was the cash at the end of the year. That is going to be then that one plus that one equals 187,080. Also something which you haven't seen before, something new, and that is great. This is a good question. I love this question.